Today we're going to have a look at how we can trade credit spreads with a 95% win rate. I love credit spreads. I always have some form of credit spread open in my account. They're a really strategic part of my trading. So today what I want to cover with you is number one, what a put credit spread is, when we use them, how to choose the strikes and the expiry, and importantly, how to manage your trade. Because all of this will determine if you end up with a successful trade or a losing trade. Now, first off, a put credit spread in particular allows us to profit if the underlying stock goes up a little, remains the same, or even goes down a little. And we get to do this with little capital required to enter the trade. So let's take a look at a real life example. I love showing real examples to illustrate the concept. So on January 14, nvda was trading at around $180. So we can see here, we closed the day at $183.14. This is a trade that myself and my students in my mentorship actually took on the day. Okay, so let's say though, you wanted to enter a trade. You've seen that you like nvda around here, but if you wanted to enter a sold put, and for example, you like this $170 mark, you think that from here, we're going to either trend sideways, preferably up, down maybe a little, but you like the look of this sort of $170 level for a sold put. Now, to enter that trade, a sold put, you'd need to have enough capital available to purchase 100 shares at your strike price. So if you've identified that $170 level, you need $17,000. And if you were to enter a 35-day long contract, give or take, you'd receive roughly $300 for that, or a 1.7% return. For a sold put, there is nothing wrong with that, especially on a stock like nvda. That would be considered quite a safe trade to place. But what if you don't have 17,000? Or what if you want more than a 1.7% return, but to get that return, you don't want to move your strike price higher, therefore increasing your risk? This is where you can choose a put credit spread. Now, with a put credit spread, what we're essentially doing is buying and selling a put at different strikes on the same expiry date. So let me show you exactly what I mean here. So on January the 14th, I sold a February 20, 2026 $165 put for $2.11 or $211. But because I didn't want to spend $16,500, I didn't want to tie up $16,500 worth of capital, I then simultaneously bought the February 20 $155 put for 97 cents or $97. Okay, so what have I done? My $2.11 minus my 97 cents is $114 times by 100 shares, $114. Let's keep playing this out. So selling the 165 obligates me to buy 100 shares of nvda at 165 if we're trading below that level at expiry. Buying the 155 gives me the right to sell my 100 shares at $155. Okay, let's put it together even further. Here's what we've done. nvda is trading up here at $183. Okay, our $165 level is all the way down here. So first thing is we've got almost $20 of wrong built into this trade, right? For this to end up as a losing trade, nvda would need to fall from 183 all the way down to below 165. Okay. Now, because the broker knows though that I have to buy at 165, he can immediately turn around and sell at 155. So if I'm forced to buy at 165, he can turn around and exercise my 155, meaning that the most I can be out of pocket for this trade is the difference between what I would be forced to buy the shares at, my 165, and what I could sell them at, 155. So $10 per share, okay? $10 per share times 100 shares is $1,000. So this is how we can place a trade with a small amount of capital. Instead of 16,500, I've been able to enter this trade for only 1,000. So with a put credit spread, your total capital requirement is the difference between your strikes. So if we've got 165 and 155, that's a $1,000 capital requirement. If we had 165 and 160 as our bought put, the difference there would only be $5 per share, meaning $500. Okay, we received a credit of 114. Remember, that was the difference between how much we received when we sold the 165 and how much we paid when we bought the 155. So we received 114 in total credit, meaning our total risk is our $1,000 minus the credit we received of 114, which is 886. So if everything turns pear-shaped and we get the worst possible outcome, which I recommend you never accept the worst possible outcome, there's no need to, but worst possible outcome is that we lose $886. The best possible outcome, so our upside is capped as well, right? Our upside, we've already received it. Our maximum profit is $114. That's the amount we already have in our account, divided by our $1,000 total capital is an 11% return. Much better, much better than our 1.7 had we have sold the put. Okay. Now here's what's really important about put credit spreads, and this is where people go wrong all of the time. I see people coming to me with losing trades, and it's always because of this. You must enter at the right time. Don't just choose a 0.2 delta on a red day. I hear that instruction and I see it on YouTube so often. It's red, sell a 0.2 spread. No, let's not do that. Instead, we want to wait for some signs of bottoming, okay? Because these spreads have real risk in them. There's a defined expiry date, and at that expiry date, we don't just buy shares, we lose the trade. Let me show you exactly what I mean by signs of bottoming so that you can get the best possible entry to set you up for success with this trade. So here we are inside our nvda chart, okay? I want to show you exactly what I mean by don't just sell a 0.2 delta on a red day. This day here, we can see we had a nice red day on Tuesday the 4th of November. We dropped from all-time highs, and you'll often hear people screaming, enter your sold put positions now. Now a 0.2 delta, if you had entered on this day, was probably around here somewhere, around sort of 185, 190. And what happens? We continue to fall. So there's never a point where we can exit this trade in a profit, okay? Same with this, a red day, and we continue to fall. A 0.2 delta would have been somewhere around here. Now you might have been okay depending on your expiry date, but you're never ahead in the trade literally until the expiry date. If the expiry was sort of here, you are always behind. So what do we do instead? We wait for a sign of bottoming. When is that sign? When we start to get a turn of the stochastic, okay? So granted, on this day here, we might have got a false entry. But if we got the false entry and we still entered, we would have entered for a strike price down here somewhere. So although we could never have gotten out of that one early, we probably would still have been okay. Where else did we see the entry? And I took this trade, was here, December 18. Because what did we do after that? All we went was up. We got this turn of the stochastic. We got the move up. We could have entered, well, we did enter this trade and exited early. Now, what did we do this week? This was our entry day, okay? It was probably a little bit early. Granted, I probably would have ordinarily have waited for the 15th of January because that's when the stochastic turned. On this date here, the 14th, when I did enter, we still hadn't turned, but I was confident that, you know what, we'd bottomed through the stochastic, and if we drop, I've got a lot of room to get to my 165, okay? So this is what we wait for, the bottom. A 0.2 delta when you get the bottom is far away, right? It's not going to set you up for being in a losing trade from day one. So that's really important. Now, let's come over to options strat and see how we can even build this trade out. What are we actually looking for? Actually, first things first, on the chart still, let's find where we think we might have a level of support, because we don't just want to choose a 0.2 delta. If a 0.2 delta is somewhere that's either too close to our strike price, our current trading price, or a 0.2 delta is too far above a level of support, we don't want to enter the trade, even if it is a 0.2 delta. So here's what I'm looking for. Where is the support? And I like around this sort of 175 level. We've had a lot of support through here, over back through here, and even back as far as July. So I feel like there's a lot of support at around this sort of 170, 175 level. So when I go over to options strat, I'm not looking to enter my trade at that level. I'm entering my trade below that level, because if this support fails, I still want to be okay. All right, so let's come over to options strat. And here's what I was able to find. So on the day that I entered the trade, February 20, I chose my strike price. I chose my expiry date, and I never choose to trade over earnings. So that was my first thing, is when's earnings? Is it beyond February 20? Yes. So this is a safe date to enter, and it's also between 30 and 45 days out. So February 20, my 165. Why did I choose that? Number one, because it was below my expected support of 170, 175. And 155 I chose because I wanted a $1,000 trade. I wanted a $10 gap, $1,000. And I choose a net credit of around about 10%. So if this net credit here was showing me $150, I would have gone lower, because I would prefer to be lower in my trade to be safer and have that 10% return. Okay. Now, what can we see down here? Well, we can see that at the moment, we're currently trading at 186. That's here. So already I'm in profit on this trade because we got that bounce up from when I entered it. But over time, how do things play out? Well, if the trading price of nvda continues to rise, I can get out of this trade sooner. So even if we only get to $200 in January sometime, I will make most of my profit. So I can see here that at the end of January, January 31st, if we're trading at around $200, I'll be at $105 in profit. That is absolutely a sign to get out of this trade, okay? We can see as well that as time goes on, even if the price of nvda falls a little bit, I can still be profitable in this trade, because all I need to happen is that we get to February 20 and we are above my 165. That's it. Now let's come back and take a look at some rules for entry and exit. So remember, to enter these trades, we're only entering on the turn of the stochastic RSI, but only if all else looks good. If it still looks like the market is in free fall or the stock is in free fall, just because the stochastic looks like it's turning, it's not an entry signal. Okay, everything else needs to look good. Don't worry about the delta. Instead, we look for 10% return lower than your expected support. So if we can't get a 10% return lower than what we think support is, we do not enter the trade. If our level lower than support is higher than a 10% return, yes, you could take the higher return, but personally, I like to make the trade safer and drop my strike prices. Choose an expiry around 30 to 45 days out, and do not trade over earnings. Yes, I know that there are great premiums on offer over earnings, but for me, trading put credit spread is too risky over earnings. Instead, you can still take advantage of higher volatility and higher premiums after earnings. So I prefer to wait until after earnings, see what the move is, and then trade the move if there's a trade to take, rather than guessing before earnings. Now, what about exiting? Always look to exit early. That's how we get to make the most of these spreads, is by getting the quick wins. It's why we want to make sure that we've potentially found a bottom before we enter, because we want to trade that next move up once we've found the bottom, not guessing and hoping that we just don't fall. So I set take profit orders. I recommend taking profit at 50%. If your trade moves and you're in profit at 50%, take your profit and go find a new trade. So what does it mean by take profit at 50%? If you received $1.14 per share when you opened, when the value of the spread reaches 57 cents, buy to close. So you received $1.14, you're giving back half of that, you're giving back 57 cents, you get to keep the other 57 cents. You've received 50% profit. The other time to enter is if things move against us. So if your sold put strike is breached, so in this instance, $165, if $165 is breached, exit the trade, take the loss. Now, yes, there are some more advanced ways that we can maneuver around this. We can look to roll, we can look to take the profit off of the bought put and leave it as an open sold put. There are lots of things that we can do if your account size allows it, and if you feel like you're experienced enough to manage that trade, because it might continue to go against you. The easiest, the safest thing to do is just exit if your sold put strike is breached. I have an account that I'm growing from 50,000 to 100,000 here on YouTube, and this is one of the strategies that I'm using in it. So if you want to follow along on that journey, make sure you follow me on this channel. Go and check out my other videos where I am laying out every trade I'm taking in this account to grow it to $100,000 in just 12 months.